Hi, I'm Nick Cada with Leo Barrick, and today it's part one in our series of tax topics for deal professionals, talking about choice of entity, specifically corporations. A lot of you may be wondering, why do I care about choice of entity for tax purposes? Choice of entity can drive everything, and more importantly, understanding what you're buying can drive everything from a tax perspective on a transaction. It can dictate, for example, the possibility of a tax basis step up, which could be material to your IRR. It could dictate your structure, how the rollover is handled, how cash repatriation is done. Really, everything comes down to, what is the tax classification of what you're buying. So it's super important, and it impacts value. And the sooner you can identify it and flag it for your tax professional, the better off you're going to be. Because raising these issues earlier in the deal versus later in the deal is imperative. The first entity that we're going to talk about are corporations. Corporations are often referred to as Incs, in legal name. They're reflected often as rectangles on organizational charts if they're adhering to the standard tax shapes kind of monikers. And they're unique in that, a corporation is a taxpayer itself. So corporations pay corporate level taxes. The income and operations of the business in that corporation or its corporate subsidiaries are often taxed in the hands of the corporation. Right now, 21% federally plus the applicable state rates. Those obviously could change in the future. But they've been as high as 35 federally, a few years ago. So they obviously flux quite a bit. But, that's the big takeaway. Corporations kind of, are taxed at the entity level. And, more importantly also, corporations do not provide the ability to get a tax basis step up for most, in most instances. If you're buying the parent of a group of corporations, there's no ability to get a step up. If you're buying a standalone corporation, there's no ability to get a step up. There's two exceptions to that. One, if that corporation makes a special election to be treated as an S corporation, which we'll talk about later in the next episode. And then two, if that corporation is a subsidiary of another corporation and you're buying the stock of that subsidiary corporation, there also may be an opportunity to get a tax basis step up. But otherwise, I think the key takeaway here are corporations pay tax at the entity level. And then when that cash is distributed out of the corporation to the hands of the shareholder, there's often a withholding tax if they're foreign, or just an additional tax if they're U.S. persons. That's it for now. Be sure to check out our other videos on our website or our YouTube channel. We cover a lot of different topics for deal professionals that I think you'll find very interesting.